Hi everybody, Jeff Yastine for Total Wealth Insider. Say what you want, pro or con, about the Trump administration's trade war strategy, but one thing is clear: it's creating an historic opportunity to buy undervalued Chinese stocks, stakes in the biggest of Chinese companies. For example, iShares China Large Cap ETF, the symbol is FXI, is down about 10% year to date. It seems that for every $200 billion poker chip the administration shoves to the center of the table, investors take a few billion more off of it by selling Chinese stocks. Well, the ETF's portfolio carries big stakes in the likes of high-flying Chinese internets like Tencent Holdings, telecoms like China Mobile, oil and chemicals, insurance and banks, and basically to play on the continued growth of China's economy. And the price you're paying for that growth relative to profits comes with some of the cheapest price tags in dollar terms that I've seen in years. For instance, over the last 12 months, the companies in this ETF have earned about $15.50 a share. Yet at the fund's current price, that works out to a price earnings ratio of just 2.6, which is the lowest that we've seen on this ETF going all the way back to 2010. That's how cheap this stock is at this time, this ETF is. And it's also quite a discount when you consider that investors were willing to pay a record high PE for this ETF of 15 times earnings back in 2013. So it's gone from being very optimistic and people wanting to pay a very high price to own the ETF to now being very pessimistic and only wanting to pay a very low price to own it. We can also see the discount from a dividend perspective as well. The fund's semi-annual distributions work out to a yield of 2.6%, which is the highest yield we've seen on this ETF since 2009. Likewise, these same companies are trading at record low stock prices compared to what their assets would fetch in the real world if you were buying them wholesale. The tangible book value of the 50 or so companies in the fund's portfolio are worth a combined $52.61 a share. That's according to data from S&P's Capital IQ service. Yet you can buy the fund at a 22% discount to that price right now, or a grand total of less than $42 a share. That's as of Monday's trading session. Again, that is the cheapest price to book value that we've seen for this ETF since 2009. Now, of course, there's a certain situation here that is different compared to 2009. Back then, Chinese equities were running in what you might call symmetry with U.S. stocks and the rest of the global stock market, as well as both mature and emerging markets were climbing out of the depths of the financial crisis. These days, the situation might be described as asymmetrical, meaning that the U.S. market is on the high end of this teeter-totter, while China and the rest of the emerging markets are on the low end. They're scraping along the bottom of the teeter-totter. Now, I don't think that situation will last forever, and when it does, emerging markets will have their day once again, and the cheapest markets, like China's, with lots of growth to offer, will be where that action is. Remember to keep liking us on YouTube, read our material on banyanhill.com, as well as on Facebook. I'm Jeff Yastine for Total Wealth Insider.